This is a complex and sophisticated model dealing with attributes of the loans that a bank sells to borrowers. Loans last for 36 months and each carries 3 attributes. First of all, each loan carries a value, which is initially $100,000. The second attribute is the interest rate that the loan carries, which determines the monthly repayments that the bank receives. Lastly, at the bottom of the model is the risk that each loan brings, indicated by the probability that the borrower will default before the loan expires and not repay the loan amount back to the bank. Marketing attracts loan inquiries each month, but wins fewer inquiries if the bank charges higher interest rates. The interest income minus the interest the bank itself has to pay for the money it lends out gives the interest margin each month, and deducting the costs of issuing and administering the loans leaves the bank's monthly profit. Any loans that default are very costly to deal with, and the value of those loans is a further loss from the bank's profit. So the choice for the bank in this case is between charging low interest rates but accepting only the very lowest risk of default to keep costs down, or accepting higher risk and charging higher interest rates to cover the cost of the loans that go bad. In this scenario, I've run the model for 6 months with no changes to the initial decisions, a low risk policy and low interest rates. Set average default risk to 8% instead of 2%, and set interest on new loans at 12% rather than 7% to cover the likely cost of bad loans. Play for a further 6 months. You'll see that the rate of new loans that we issue has fallen, so as existing loans are repaid, the total number of loans outstanding falls, as does the total value of the loan book. Total interest income falls more slowly as the higher interest rate slightly offsets the falling number of loans. The total number of loans that will default, though, rises because although we're selling about half the previous number of loans, those that we sell are more than 5 times as likely to go bad. But if we scroll back to the top of the model, we'll see that the profits are now growing quite strongly because of the much higher interest margin we're making on the loans we issue. Play on some more to the start of month 19, and you'll see that at this point the profits at the bank fall back because we're now starting to see loans going bad, long before the 36 months that they were supposed to last, and this costs us a lot in administration and write-offs. Play to the end, when the number of loans, the total value of those loans, the interest income and the profits all stabilise at a new level where all the original low-risk loans have been replaced with higher-risk loans. You can try other scenarios, for example with a much higher risk of default, which reflects difficulties that US and some European banks got into in the years up to 2008, issuing so-called subprime mortgage loans to people who could never pay the interest charges.